Coming up today, stocks rip higher after the Fed cuts rate, the latest from Powell, Goldman's outlook for 2026, the new space race, and the torrent of liquidity coming for markets. It's another great day, guys. Let's go. Well, there we have it, the last Fed meeting of the year, and we did indeed get the cut, plus a little icing on the cake with some new treasury bill buying announced. Fed's going to plow $40 billion back into the markets each month, getting back to expanding their balance sheet. I'll touch on that a bit later, but just looking at the market's reaction today, no real surprise to see financials outperform, really sensitive to rates, along with other cyclical areas of the market, industrials. Overall bullish day, but not completely. Did still see a number of high beta stocks out there actually finishing the day a little bit lower, along with a little softness in crypto. Sometimes you can see that delayed reaction or kind of muted response from what's otherwise a great fundamental development, but overall pretty good. Russell 2000 small cap index breaking out to a new all-time high, delivering more than double the return of S&P 500. Large cap index today was actually mid cap, leading the charge up almost 2% for the day. Breaking out in heavy volume here was also good to see the equal weighted indices outperforming the headline market cap weighted indices. That's what we want to see in a healthy bull market. A good sign of improving market breadth where more stocks are rising instead of just the biggest one. Best performing sector today, regional banks, 3.5%, very sensitive to rates, as are home builders, catching a bid there today, 3%, and industrials potentially breaking out of this months-long consolidation. Big volatility crash, fear getting sucked out of the market. Bit of a U-turn there for bond yields. We're creeping up going into the Fed decision. Say overall, we did get the hawkish cut the market was expecting, but nonetheless, yields came off here a bit today, especially up the front, helping high yield bonds find their footing. Also having a good day, as it all pretty much came in line as expected. Looking at the technical price action, the market appears to be, at this stage at least, treating it like a market clearing event instead of a sell the news. We pretty much didn't get any real surprises. We knew there was going to be dissent. Two Fed members wanted to stay on hold. One wanted to go for a larger half-point cut. That was Mirren. Dot plot didn't really change. Fed actually firming its projections for economic growth next year, thinking GDP will come in at 2.3%. Powell saying it looks like the baseline will be solid growth next year. He's actually been surprised at how well productivity has been growing. Saying it could be generative AI, but he doesn't really know. The pandemic may induce people to do more automation and do more things with computers to replace people, and that raises productivity output per hour. Also acknowledging inflation has come in lower. Tariff may not be running the economy hot. Pretty much being forced into that stance because the data is simply undeniable, along with market pricing on inflation as well, is really dialed in these last few months. Also noting job creation may be negative, hence why they have to cut rates to try and give those less fortunate a helping hand, something he should have done months ago. As I agree with the sentiment coming from Kip Harridge today, a managing partner. With inflation under 3%, the Fed funds rate has remained around 4%, but somehow from 21 to 22, when inflation was at 40-year highs, Powell kept the overnight rate at under 1%. Remember that whole inflation was transitory, which turned out to be dead wrong. Then this year he was saying, we're getting inflation because of tariffs. Wrong again. Nothing about this makes sense except that Powell's the most political Fed chair of our time. Time for him to go and the market knows it. The market couldn't care less what Powell says. In his presser today, he's a lame duck with little to no power, and I agree. The market's just simply looking forward, like they always do, to when we're highly likely to get Kevin Hassett, big-time monetary dove, likely to lower rates, which is great news for the stock market. Stocks always love lower rates when the economy and earnings are still growing. Fed cutting rates because they can, not because they have to. It's a completely different scenario compared to if the Fed's worried, or there are immediate signs of the economy turning down, but we simply don't have that. They're actually increasing their GDP forecasts, but because of a soft labor market, they're forced to cut, which, like I've been saying, is kind of a Goldilocks scenario for the stock market, and we've already kind of seen that being anticipated with this big volatility crush. Looking forward when that happens. Returns for the market can be great, 6 months out, 12 months out. And what's possibly even more bullish for the market than lower rates, setting up for a double whammy, is the Fed getting back, increasing their balance sheet, announcing that it will buy $40 billion worth of treasury bills per month after just stopping their shrinking of the balance sheet. We've seen banking liquidity get a little low of late. I think he realizes he could have done all this a few months back if he weren't speculating on inflation. But whether you call this quantitative easing or not doesn't really matter. It's all just technicalities. I think you need to pay attention to this because the Fed is printing money to provide more liquidity to banks. The net effect on the markets is the same. Welcome back money printing. And here's a look at the Fed's balance sheet. The last time they increased it, starting in March 2020, all the way into March 2022. Monster, huge rally in equities, high beta stocks, growth assets. Then we had a huge wave of inflation. They hiked rates and reduced their balance sheet. Somehow we haven't gone into a recession throughout all that. The market's held up, the economy's held up. Rates have just come off 4%, still plenty of room to go lower. Economy and stock market still humming along now. This line's about to turn higher again. Opening the window, Kevin Hassett, to accelerate it as well. What's already been put in place before he even gets in as Fed chair in May next year. So it's good to see Jay Powell just getting the ball rolling early. And so this is all looking good now before we haven't even got a big time dovish Fed chair yet, where they could really light it up next year along with fiscal stimulus. And if you're wondering what area of the market is that most bullish for, I'll tell you right now, it's small cap stocks. Lower interest rates, renewed liquidity support will loosen financial conditions across the economy. For small companies, which often carry floating rate debt and are more sensitive to borrowing costs, this translates directly into lower interest expenses, stronger cash flow, more ability to finance growth, and more breathing room to invest rather than just servicing debt. That's why often throughout history, we see small caps outperform large caps after the Fed cuts rates. And with all the political winds aligning, all levels of agencies, government and Wall Street joining hands, it's really setting up for what could be a huge 2026. Wall Street analysts increasing their forecast growth for small cap earnings, potentially looking at 59% growth in earnings per share for the Russell 2000 index next year, which makes sense when you've got lower discount rates, easier access to capital. It's kind of like a rising tide lifting many smaller businesses across all sectors sensitive to the economic cycle: industrials, materials, discretionary, financials. Coming at a time that small caps have been trading at a record discount to large caps, especially the Mag 7. With small cap indices still trading on a next year PE of 15, which is incredible in my mind. Earnings yield above 6%, with overnight rates on their way to 3%, half of that, which we've never really seen that sort of mismatch before in history. Huge earnings growth forecast for small caps above large caps at a time when they're super cheap relative to large caps. Add on top of that loosening credit conditions, and that's exactly why now is an ideal time to join my stock pick service if you haven't done so already, which focuses on investing in small cap growth stocks. I send out a deep dive report every Sunday morning on what small cap stock I'm going to invest in the next day using my own money, along with keeping transparent performance tracking inside the private members area so you can see exactly how my portfolio is performing. You won't find any other FinTuber doing this, even though their videos get lots of views. From fooling the masses on unknowing newbies, the fact is they don't actually trade, nor do they keep track records of their vague trading ideas. Instead, they try to sell you stuff that borders on straight up fraud, in my opinion, using fake review to create the illusion of success. So if you're tired of all that BS and you want to join a community of real traders and you don't want to miss out on what could be the best year for small caps that we've seen in a long time, then click the link below this video, visit my site clickcapital.io and use code BOOM26 at checkout to lock in your 26% discount and get in early starting today, because if not, like many bears on here, you're probably going to find me to be insufferable next year when you see the huge gains that you've missed out on. So jump on board today, what is still likely to be the greatest bull market of our lifetime. Now just moving on and looking at one of the top Wall Street investment banks, Goldman Sachs, and what they see as some key themes for next year. They see fading tariff headwinds, rising real income. That means income growth will still be above inflation. Think American economy is going to grow at 2.5%. The impact of tariff pass-throughs is diminishing. They see a potential further deterioration in the US labor market. They expect additional rate cuts, opportunities of cyclical acceleration and earnings momentum. Think emerging markets can continue to do well on the back of a lower dollar, commodity momentum. New Fed leaders really going to shake things up. Corporate balance sheets are strong. Any credit events will continue to be localized. Dollar could keep falling along with oil as well, but gold may continue to hold up. Looking at America's second largest bank and what they see coming next year, they're more bullish than the consensus US GDP growth. They don't see an AI bubble yet. Bullish on emerging markets, which can often come with a lower US dollar. They think China will surprise on the upside. They expect more broadening of the stock market rally. Think bonds could do well. The long end of the curve will stay flat along with home prices. And of course, we can always get some volatility in a midterm year. Private credit returns likely to be lower, and they see copper, one of the best performing commodities next year. I think we're also likely to see an acceleration in the AI boom, the next phase going into space. The biggest companies are already making plans to start building data centers in space because you've got an abundant supply of energy. You never lose the sun. So that's no real problem. The real challenge is cooling. So I expect to see advancements in that area. And we've even got NVIDIA backing a startup called StarCloud, training an AI model from space. And the world's richest men going for it as well. Bezos and Musk, all talking about moving AI data centers off Earth into space. Along with Google, I think that will be the future for data centers. And going into the potential SpaceX IPO next year, I think the space industry and a lot of stocks in it, Rocket Lab, AST Space Mobile, another one we've got in our picks portfolio, Planet Labs, all look pretty good for next year as a high beta play on this nascent industry. And there's a look at Planet Labs, which just reported earnings, ripping up here after hours, 13%. Nice bounce back in Rocket Lab of late, did have a big day there today, and AST Space Mobile as well. And an ETF to play this is the ARK Space and Defense Innovation ETF, which has also just come back to its 50-day VWAP. Not a whole lot of headlines out there today, but one we did get is one of the hottest hedge fund managers of late, especially on X, guy behind Carvana and Opendoor. And that's Eric Jackson, with his latest pick today being Nextdoor, which he thinks is an underappreciated AI play, saying the company is a misunderstood play on a genic AI theme. With his post on X saying Nextdoor at $2 today feels like a great opportunity. And his posts do move the market, given it's a small cap, still under $1 billion in market cap. Stock was up 25% today, ripping here after hours. And there's a look at the business website, which is kind of a social media network connecting neighborhoods and businesses, which he thinks is going to turn into an AI play, which I guess any company can if they want now, similar to Opendoor, using AI to better flip houses, buy and sell them, which really caught the market's attention. But the stock, like many in the high beta space, has been pulling back and consolidating for a few months. And just wrapping it up, looking at the market overall, S&P 500 just sitting below 6,900, only just a few points off all-time highs. Looking across market trends, pretty bullish setup. Volatility downtrending, as is oil, defensive sectors, and the dollar. We just still haven't seen a massive rotation back into growth high beta yet, nor have we really seen that big monster green candle for Bitcoin, crypto, and high beta growth stocks yet as well. I think that could come tomorrow or the next day once the market digests what's just happened. Pretty bullish move for the Fed, not only to cut rates, even though that may be Jay Powell's last rate cut before he leaves in May, just opening the door back to expanding their balance sheet again, which Kevin Hassett could very well dial up, is very supportive of markets. The initial price reaction is quite bullish, looking at small cap indices, the crash and vol, and yields pulling back as well. I think that all looks pretty good. And we've pretty much only got a few weeks left in the year. No real big prints or announcements or earnings until we get into January. So the market's kind of left to trade on its own devices until then. And so we'll be looking for some follow-through action tomorrow, where we may get the true look at how the market's feeling and whether that bullish Santa Claus rally could be coming as well, after we've still got heightened levels of fear and pessimism out there. Fear and greed index still in the fear zone, while the market's trading at all-time highs basically. But we're still plenty of work underneath the surface to be had across growth sectors and stocks. Still plenty of catch up out there to be had. But so far it all seems to be playing out beautifully, just as I've been forecasting this whole year. And I think next year could surprise even more, as a lot of people really aren't positioned for what could be coming. And so overall, I've had a fantastic year, and I think next year could be even bigger. And if you'd like to jump on board with me, now's your opportunity. Click the link below this video and use promo code BOOM26 at checkout to lock in your 26% discount and get positioned for 2026 just as I am. Thanks very much for watching. My name's Jared, and I'll see you back here again this time tomorrow. Cheers.